Yeah.
Good morning, everybody, and welcome to this special hangout on Taxsutra Domestic TPedia. Domestic TPedia is a special microsite hosted by Taxsutra and Wolters Kluwer CCH. The website brings to you all the information and content relating to the new law on domestic transfer pricing. We have a special guest today with us, Mr. Yogesh Thar, who has also authored a book on domestic transfer pricing, law, practice and procedure. It's in fact the first book on this subject and published by CCH last year. Thank you so much, Mr. Thar, for joining us on this hangout. And let me begin with sort of understanding your experience in the first season of domestic transfer pricing compliance that took place last year.
Well, experience is really limited to compliance, as you rightly said. There's no experience with the department so far, because we'll have to really test the views that we have taken on various issues. There have been interesting cases, interesting issues that have cropped up in the in the last year's compliance. Like, say for example, there are cases where there's an interaction between 40A2 and 80IA. Like, I have a unit in a 80IC zone, and that particular unit makes a purchase from a related party. So that purchase from related party is something which is covered under 40A2, and at the same time that goes to the debit of my P&L account of the 80IC unit. And from the 80IC point of view, I have to also make sure that I am not making more than reasonable profit. So what really happens is there are two divergent objectives. 40A2 objective is that you should not be paying more than the market price, and 80IA objective is that you should not be paying less than the market price. In other words, that you are making making profits that are not extraordinary. So you have two divergent. So theoretical answer to this is your price should be exactly equal to the ALP, so that there is no addition from 40A2 point of view and there is no disallowance from 80IA point of view. So this was one of the interesting challenges that we came across, and we of course tried to manage taking some views and following two different methods for benchmarking for two purposes. The major challenges really come from the availability of the data, because in the domestic, unlike international transfer pricing, in domestic transfer pricing you do have a huge unorganized sector domestically, number one. Number two, the department has 133.6 tool with it, whereas the SSC does not have that access to the data which the department really has. So that was one more challenge, and that is an area in which really a lot of work needs to be done going forward by also very strong view in terms of domestic transfer pricing that if a transaction is tax neutral, that particular disallowance provision does not get attracted at all. Now, so question arises whether in such cases do you need to get into transfer pricing? Do you need to benchmark? What sort of view does one really take? So these are complex legal issues which we have come across, and we have taken positions in different cases on different issues. And one will have to really wait and watch as to how the department takes a view and how the appellate authorities ultimately deal with it. So it was quite challenging. First season really was quite challenging in terms of various issues that arise.
Right. And Mr. Thar, how has been the reaction and the preparedness from the clients, from the companies? As you rightly mentioned, unlike the international transfer pricing, the companies which are subjected to the domestic transfer pricing are perhaps slightly from unorganized, if we use that word crudely, and also dealing with infrastructure and so on and so forth, where documentation and availability of the data could be a huge challenge. So, how has been your experience with respect to the preparedness of the client on the domestic transfer pricing compliance, and any learning out of your discussions, interactions with the client that others can sort of carry in the coming years?
Yeah, sure. So, what really, you see that what has been happening traditionally in smaller companies, I'm not talking about larger companies, things go on happening, as per last year, typically, and people go on certifying things as per last year. No serious exercise was really, we found that no serious exercise was made to, benchmark the transactions on arm's length, and the fact that in the past no disallowances have been made and the department has been accepting your transfer prices as it is. Not much efforts had gone into. So what we started immediately thereafter was to advise the clients that we should do some sort of a concurrent study rather than wait for the year-end study. And on a concurrent basis, on say quarterly basis, we identify a transaction and we do some sort of a benchmarking, maybe based on earlier year's data, market data, because you don't have the market data of the current year anyway available. So you do some sort of a benchmarking on an ongoing basis, and so that you have sufficient time to take corrective actions before the year end. And people have implemented that, and they have really, in fact, there were a lot of eye openers that we came across. When we get into on a concurrent basis, that once you get into this exercise, something which you like, say for example, a person would regularly transfer goods based on the assessable value under the excise law. Now that assessable value under the excise law is based on a fixed formula, say cost plus 10% or cost plus 12%, and that just does not tally with the arm's length pricing mechanism that you need to follow under these rules. So those sort of things have undergone change in the second year onwards, where where a proactive approach from the SSE to do sort of a concurrent study on an ongoing basis, that has really helped us. So we in our office have advised people to go for a concurrent sort of a study on a quarter to quarter basis. And of course there were a lot of other improvements, like you have a system of getting quotations even in cases where you don't get quotations in cases where you are dealing with your related party. You have a system otherwise in place, but you don't do that. So you start doing that even for the transactions that you do with a related party, and then that goes quite a bit to help the SSE. So like that, issues have come up if we do some sort of a concurrent study on a month to month or a quarter to quarter basis. Certainly at the year end the difficulties are much less.
Sure. I think that quotation is an interesting point, and perhaps the newly introduced sixth method is a blessing in disguise, and perhaps has been introduced just at the right time when the domestic TP also kicked in.
Right.
Out of Mr. Thar, out of your several clients and industries that you looked at for domestic transportation compliance, you have API, IC deduction on range of industries, power, infrastructure, hotel, real estate, and so on. Which is the most difficult industry in terms of getting the data and doing the compliance out of your last year's experience?
Well, I think smaller the SSE, larger the problems, because as I said, you have many players in the small scale sector, in the private company sector, where many a times you don't get the data because they don't upload their profit and loss account on the MCS side. So smaller the clients, larger the difficulties that we have faced. It's not really a sector-wise issue, but it's really a getting data is a major issue where unorganized sector being there and we don't have access to the data of other players in the industry. That's a problem that we have faced. Otherwise, other things are all legal issues and taking a legal view one way or the other. But not getting data is something which makes the entire exercise a non-starter. So it becomes difficult. That's one of the major difficulties that we have faced.
Right. And any particular specific approach that you have adopted to ensure to sort of offer the next best set of data to ensure that you meet the transporting compliance and the fixed methods and so on?
Yeah. So one will have to definitely then look at the data which is available in the public domain and take some calls. If there are no segment reporting, then you take some calls based on the general knowledge or based on the analyst reports and based on things like that. No, I don't think that we can bracket any sort of single approach to this whole thing.
Okay. Coming to certain specific issues in the computation, in the benchmarking under domestic transfer pricing, initially in our discussion you mentioned about conflict between 40A2 and API A or IC deduction, where there is a sort of approach which is in the opposite direction. But the other way, perhaps from the department side or from the revenue side, the argument is that conceptually both 40A2 and API 8 or 10 type of a situation or provision were already on the statute book. We are now only giving a method to this madness, if we may call it. Have things really changed in a pre-domestic TP scenario and the first year that you saw specifically on this point, 40A2 versus API 8 or 10 conflict?
No, I fully agree with you that if we go back to the roots of this enactment, no change is intended, and that is also one of the fundamental aspects that one considers in interpreting all these provisions. Really speaking, no change is intended. All that is intended is to provide a mechanism and therefore remove uncertainties or subjectivity in the entire determination of arm's length price. And secondly, maintaining adequate documentation for the purposes of enabling the officers to take a call one way or the other. So this was the intention, and therefore really it's really formulating an objective mechanism and a mechanism for computation and a mechanism for maintenance of documents. That is the purpose for which this legislation. It's not intended to change the computation at all. It's not intended to change the computation. I fully agree with you that. But when you implement it and you find that you have these two conflicting provisions, you have not noticed this earlier, and you start noticing it. That's the only thing that happens.
Oh yes. Another point you touched upon, Mr. Thar, in the initial opening comment is on whether domestic transfer pricing is a charging provision or is a provision to merely compute the arm's length price. And I'm actually, in this context, referring to your preface to your book, and you've written a very nice comment over there, which I will just read out, is that similar to the law of heredity, under which it is said that the traits and peculiarities of a father generally flow into his son, even here with the introduction of a branch of the transfer pricing regulation, various controversies and issues relating to the transfer pricing regulations has automatically traveled into this new branch. Coming to the controversy on share issue, etc., which is already pending before courts. The fundamental point on whether domestic transfer pricing is a charging provision or a computation provision can be a matter of debate. Any thoughts, any comments on domestic transfer pricing approach? Is the controversy similar to international transfer pricing, or is it different vis-a-vis international transfer pricing?
Yeah, it is definitely different, and I think by mixing up the two in one chapter has created all these issues which should not be there, because all that was required was to provide a mechanism and therefore apply the rules for computation which are there, and to apply the rules which are required for documentation. To bring the entire chapter, to make the applicability of entire chapter 10 was to my mind not required. Just simple provisions at the end, like they have made provisions at the end of the relevant sections 40A2 and 80IA8 and 80IA10 and 80IA6. They have made specific provisions because of which you go to arm's length price, but then you end up in chapter 10, and chapter 10 has all these interpretation issues. So I would have thought that if only the rules for computation and rules for documentation, if they were made applicable, then the purpose and the mandate that was direction that was given by the Supreme Court would have been fulfilled, and the entire chapter 10 would not really become applicable, and then there would be all sorts of then there would be some clarity, because like say for example you have an issue in 92.3. 92.3 really says that if you are computing an arm's length price based on your books of account, the price recorded in the books of account, and the arm's length, the price that you compute, profits that you compute based on the price recorded in the books of account, and the arm's length price which is computed as per the method, if that arm's length price results in a reduction of profits, then this chapter does not apply. Now that sort of a provision does create some difficulty. Like say for example, I am transferring goods to my other undertaking, an eligible undertaking transferring goods to another ineligible undertaking at cost or at accessible value, and I record that in my books of account. Now earlier, for the purposes of ATIA-IB, I would compute the market price and say that okay, this cost which is recorded in the books, that is only for the management reporting purposes, it has no meaning otherwise. For the purpose of ATIA-IB, I am supposed to take market value, so I will take market value and compute my profits for the purpose of ATIA-IB. Now that was not a problem at all from the point of view of getting your ATIA-IB deductions in the past. Now that this 92.3 has been introduced, it becomes a little dangerous, and a literal interpretation of that would really mean that if your arm's length price is such that your profits are reduced, then this chapter will not apply. So therefore what? If this chapter does not now your ATIA 8 says that you have to compute your market price based on arm's length, When you go to arm's length, you have this chapter 10 saying that in certain circumstances this chapter does not apply. So now what do you do? So therefore, those who are recording these transfers at cost or at assessable value or at a cost plus standard margin or something like that are in a problem. I mean, if on a literal interpretation. So these are the issues which crop up because you have mixed up these two things. The entire objective of international transfer pricing and the objective of domestic transfer pricing are different. The international transfer pricing, there is economic double taxation, or there is in international transfer pricing there is a tax which is not paid in a particular jurisdiction, and therefore there is a justification for transfer pricing on income side, expense side, both. Insofar as domestic transfer pricing is concerned, if one plainly reads 92 the subsection 2a, one may come to a conclusion that it applies even on the income side. But fortunately, because of the restricted definition of specified domestic transaction, it cannot apply to income side. It cannot apply to it cannot apply to the above gross total income level, except for 48(2) issues. So all these interpretation issues which came up in first 6 to 8 months were probably because you have mixed up the two things, and in administrative wise also, I think administrative machinery in the tax department, I think domestic transfer pricing should not be mixed up with international transfer pricing officers to do the job. They have to. There should be a separate, either a separate cell or your regular officer does it. Because the outlook of the officers dealing in international transfer pricing is completely different than the outlook of the domestic people. So that's, I think, in a way mixing up the two has created some sort of a problems.
Right. Another point which has been discussed, debated quite a bit since the introduction of domestic TP is the director's remuneration and benchmarking. Over here in our discussion, Mr. Thar, let's specifically focus on privately held companies, not the listed companies where you have stakeholders who somewhere approving the remuneration. But in case of privately held companies where you have a members who are also directors and getting the remuneration commission from the company. Any specific, there are multiple approaches, but as I said, it becomes particularly more difficult in case of to look at, to apply, say, for example, company law limits to justify the remuneration. Any specific approach which you have found more sort of appropriate in your last year's experience, and anything specific that you are suggesting to your clients this year, because in case of private limited companies, this can be an important area, and 5 crore threshold can easily be crossed even with just this one item in the P&L.
Yeah, I think we have by and large gone by the Companies Act schedule. Whether it applies to a private company or not, to my mind, is not relevant, because the rationale is like that. Okay, you use a data which is there in the public domain. Whether you are testing a partnership firm, or whether you are testing a private company or a public company or a proprietorship firm. So you use everyone's data to the extent available in the public domain. So therefore, if there is a law which says that a particular level of remuneration is acceptable, then we have considered that as a benchmark, number one. Number two, so far as director's remuneration is concerned, the real issue is 48(2), and for 48(2) you have a board circular which says that if the company law board has accepted a particular level of remuneration, then the tax officer cannot consider it as unreasonable or excessive. Now that circular still prevails; it's not withdrawn. So therefore, from the point of view of 48(2), I think so long as the remuneration is within the limits of the company law, I think that should be acceptable, and we have by and large gone as per that approach, because Otherwise, we have found there is no way whatsoever to really benchmark this, because every other company paying remuneration to a director is a controlled transaction. So you can't have an uncontrolled transaction. As you can't use cup or you can't use any other method, because it's otherwise a controlled transaction everywhere. So the mechanism would really fail. So therefore, this is the only way in which we have gone about doing this.
Sure. And out of all the transactions to which domestic transfer pricing applies, director's remuneration is probably the only transaction where, in most situations, it is certain that the revenue neutrality will be achieved, and especially since there is a mechanism to deduct tax at source on payment to the directors, it's also easy for company to ensure that appropriate taxes have been paid on this. This argument, how strong do you think would be there as far as the interpretation and applicability of domestic TP to directors' remuneration is concerned? And have you seen any of the clients take up this argument in the benchmarking?
Yeah. That, in fact, there's two things. One is directors' remuneration, similarly with partners' remuneration also.
Sure.
And for partners' remuneration, in fact, there is a specific provision in the law which says that to the extent it is disallowed under 40B in one place, it will be not taxed in the case of the partner. So, but there it is 40B, not 48(2)B. Okay, so right. So anyway, now coming to the tax neutrality issue, I feel it's a very, very strong thing, because you have a decision of Supreme Court which supports that. You have other couple of decisions to support that if there is a tax neutrality, then the provision does not apply at all. So in some cases, yes, people have taken this stand. However, they have benchmarked for the purpose of compliance with the section, because otherwise, if you have not benchmarked, we know that in international scenarios, they have levied penalties and whatnot. So we have benchmarked. However, we have said that this is not. There can be no addition under 48 whatsoever because of tax neutrality, and these are the decisions in that favor. So people have taken that stand. Yes.
Right. And you brought up the topic on partnership firms. Likewise, the trust is also an interesting category of assessee, and perhaps not much discussion has taken place on applicability of domestic transfer pricing to trusts. Any specific experiences in the last 1 year where domestic TP to the trust has been sort of considered or evaluated, Mr. Thar?
Applicability to trust, not much, because we hardly have any business trusts. Trusts carrying on the business to whom for whom you make computation, business computation. Trusts are by and large used, for shareholding purposes and things like that. We have family trusts where shares in companies are held by trusts. So there the questions have arisen as to whether that trust can be regarded as a beneficial owner, or who can be regarded as a beneficial owner. If there is a beneficiary in a trust which holds, say, a beneficiary in a trust which holds shares in my company, and I have transaction with that beneficiary, would 48(2) apply or would it not apply? Because therefore the larger question really is that would 48(2) go to an indirect level, or it should be restricted to the direct relationship level mentioned in the section. So so in that context, yes, we have faced issues, and we have taken calls on this particular issue where trust shareholdings are there. Otherwise, applicability to trusts, yes, we have. I believe there is a Madras High Court decision where a view has been taken that trust 48(2) would not apply to a trust or something like that. And that's because, trusts, there are decisions to say what is the status of a trust. The status of a trust is that of an individual and not of an EOP and something like that. And for individuals, the provision is restricted only to certain, disallowance is restricted only to a small types of cases. So dealing with that individual or a relative of that individual and things like that. So in that context, you do have a Madras High Court decision, but practically I have not come across, because we don't have any business trust, private trust carrying on business by itself. Trusts are used as holding entities, otherwise holding entities from the family point of view, from the succession point of view, from the point of view of dividing the economic interest and the controlling interest in the company. Trusts are used as investment vehicles more.
Right. And so I'm picking up one specific sector for our discussion, real estate especially, which is eligible for Section 80IB deduction. Also, the way the real estate industry has emerged, there have been a lot of group companies and therefore entering group company payment, which then attracts Section 40A2 and therefore domestic transfer pricing. Any one or two critical issues that you have seen in the domestic TP compliance specifically for real estate, especially the development agreements wherein two related parties are involved, one which is sort of owner of the land and other which is doing the development.
Yeah.
How domestic TP would apply to such transactions could be a challenge, both on the applicability and then in the consideration side. Would be really keen to get your thoughts on applicability to the real estate sector.
Yeah, interesting issue. Now, in the real estate sector, when you debit a particular expense, so you have a developer which has, say, acquired a plot of land from an owner who is a related party. So it sort of debits its profit and loss account with the value of the land, and then it carries it forward. Or if there are any expenses for construction contracts or for anything which they have debited to the profit and loss account, but they carry it forward because the project has not yet started or sale has not yet started. Now that is one situation.
Or you may agree to give an area in return or as a consideration for the plot of land. Okay. In which case you may not necessarily record the cost of plot of land, but you may only incur the development cost.
Yeah, correct. I'll come to that. Let me finish what was there in my mind. You see, if there is a debit to the P&L and if you're carrying it forward as a part of stock, then there have been some decisions of the tribunal to say that all these disallowances would not apply because I have not effectively made a claim, and those disallowances will apply in the year in which I actually make a claim. Now, people have gone by those decisions, but frankly speaking, we have not been advising that sort of approach, because there you are really postponing the problem that is there today, you are postponing to tomorrow. Number one. And number two, there are two different issues. One is a debit to the profit and loss account and claiming it as a deduction. And second is the valuation of your closing stock, and therefore you are valuing your closing stock and carrying it forward. So the line of decisions which are there, which say that because you are not effectively claiming and therefore there is no question of disallowance, is probably, to my mind, mixing up the two issues. One of a debit to a P&L account and two of the valuation of closing stock. So therefore we have not been very adventurous in giving that sort of advice, and we even though the entire cost is carried forward, we have sort of taken a view that you should benchmark and report in this particular year. So that was one aspect. Coming to your aspect of area sharing, where you have two joint venture partners. One is bringing in joint ventures, no, but say a joint development agreement, where one is bringing in the land and he is not paid anything, but he is paid in terms of constructed area. So what you really incur is the construction cost, and the construction cost that you incur is something which is paid to a third party. It is not paid to. It is not something which you are paying to the person as a compensation for his giving the land. So the payments in respect of the expenditure, because 48(2) applies where the payments in respect of an expenditure is made to a related party. Now the payments in relation to this expenditure that you are claiming are not payments to related parties. These are all payments to unrelated party, and therefore prima facie this provision does not apply. For in an area sharing situation. What really happens is that part of the stock which you have constructed, you don't carry it forward. You don't write it off. After carrying it forward and recording your sales. Otherwise, you are passing two notional entries, one on the debit and the other on the credit, which you don't do. I guess the way the accounting has been done by the industry today, there is no scope of applying 48(2) in such cases. But I agree with you, it's an interesting angle if the department looks at it the other way, that you should debit the P&L account and you should record that amount as your sale. And I don't know where we'll end up.
Right. Very interesting. As you again rightly said, the problem of the international transpricing will continue, and you have another set of new issues coming up, which may potentially make domestic TP as complex as the international TP perhaps in coming years.
Yeah.
My two last questions or comments, Mr. Thar. Of course, the financial year has ended, and most of the companies would be in the process of closing out their books of accounts for the financial year 13-14. The compliance for this year for domestic transpricing is due by November. Any specific steps that taxpayers should consider proactively before closure of the books of account, which sort of benefits them for the compliance and the domestic TP?
I think on the proactivity we were taught that I think sort of a concurrent audit would be really helpful, because otherwise you wait till November and then you don't know what happens, and then it's very late to take any corrective actions. So on a proactive question of yours, I think that's what I would probably repeat, that everyone should really get into this mode of doing a concurrent study on a month-to-month or a quarter-to-quarter basis. That's the best that one can really do.
Right. And one last aspect relating to the domestic transpricing is Form 3CED, which is an important document that gets filed with the department. Any specific issues, limitations that revenue should consider for this year, which will reduce any hardship that's there to the taxpayers? Because last year being the first year after the form was notified, various taxpayers faced various issues in reporting domestic TP compliance in Form 3CED. Any comments relating to 3CED, Mr. Thar?
No, not really. I mean, there were issues on uploading, which my office did mention to me.
Sure.
But some way or the other, we have overcome those issues. Either by making some entries and then writing letters. Now, this is something which is very common even for uploading your returns or uploading your tax audit reports.
Right.
These issues have come up, and that's bound to be there because of teething problems. So over a period of time, those things will get settled down. No, nothing specific that comes to my mind right now.
Great. Mr. Thar, any concluding comments, any larger comments on which way domestic TP is heading to? Of course, from department side, they say that the actual compliance and administration is a couple of years away, when actually the tax returns for the year will get picked up for the scrutiny, etc. Any comments on how domestic TP will shape up, and any preventive action that government should do in the coming budget on domestic TP?
Well, I would feel that since the area of domestic TP or the objective of domestic TP and international TP, as we discussed, are different. A slightly different approach is necessary in the domestic TP. As I said, assessing officer has a power under 133(6), to get the information, and the SSCs do not have that information. So, for the domestic TP, I think that 133(6) issue should really be removed, because there is a huge unorganized sector where they will be able to get, the department will be able to get the data, and then at the time of assessment, when they confront that data to you, you are at a complete loss how to distinguish that from your data, because whatever data they give also would be very limited data. You don't know what's there behind the company, what has influenced their pricing and things like that. So the 133(6) power, really speaking, should be removed from the, if we are to follow these methods, then let those methods be followed based on the publicly available data, which is equally available to the SSC and to the tax department. If possible, go forward and devise a particular software, which is the common software used by the SSC and the department. Why do you use something behind the back of the SSC and then take him by surprise? So even in the international transfer pricing front, I have not been in favor of using 133(6) as a tool, because ultimately you take your decisions during a year, and when you take your decisions during the year, that data for the year anyway is not available. So therefore, internationally you have a position where you use last 2 years data, 3 years data, or an average of last 3 years data you use. But here you say no, you have to stick to the current year's data. Now you stick to the current year's data, which is available to you at best on 1st April of the next year. So that's a very, very big limitation. And coupled with the power under 133(6), the SSCs are many times they are taken by surprise, and certainly in the domestic transfer pricing front, this will create a bit of a problem for the SSCs. That is number one. Number two, there should be a move, I suppose, to increase the database otherwise, because say for example private companies do not upload their P&L accounts, so you don't have the P&L account of the private companies, you have only balance sheet. So I don't see why private companies should not upload their profit and loss account. It will have all sorts of issues in terms of competition, etc. But then the tax department is anyway using that data against you if they have that with them. So if they have that with them and they use it against you, where's the question of competitiveness? Because they will have to confront that data to a person to whom against whom it is to be used. So if all companies upload their accounts, then probably the database would be larger, and one would get the benefit of looking at a larger database and benchmarking its transactions. So that is another angle. It's a larger issue. It will need a lot of debate to make those sort of amendments and require private companies also to file their profit and loss accounts. The third is probably I had referred to 92.3 in the earlier part of the discussion, and that is a provision which needs, which should not really apply to domestic transfer pricing. It needs some sort of a review. That if you don't record your transfer price in your books of account because of genuine reasons, because it's an inter-unit transfer, you don't record anything in the books of account, you just record it at cost. Now such SSCs will find that the tax department may take a very negative view just because of the applying the 92.3 mechanism and not allowing. So that will create a lot of litigation in the years to come in that area. And one more aspect is that concept of close connection, where definition is not very clear. All that we did last year was to take some help from the forms, because the forms talks about 48 2B parties only. So based on the forms, we have reported only 48 2B parties, and therefore this close connection concept is something which either you have a definition which is exactly the definition of 48.2 so that it gives certainty. Because earlier what was happening was it was the assessing officer who had to, the ball was in his court, and he would really say that that he is satisfied that that this deal with a closely connected entity is not at arm's length. So SSC did not have to do anything. Now the point is that he has to report. Now for the purpose of reporting, he has to take a call whether this party is closely connected or not. Now in absence of an objective definition, it becomes very, very difficult. So therefore I think in that area, if the definition is made exactly the same as 48.2, then that some sort of an uncertainty would go away. And finally, the margin of error. Margin of error you have today is 3%, and in case of wholesale trade 1%, which I think is a bit too strict. In an international scenario, it's probably okay, but in a domestic scenario, it's a very small margin of error that you are providing. Even genuine cases would have to face difficulties or disallowances. So that, to my mind, needs some sort of a relaxation in terms of margin of error. That 3% should really become 5% or 10% in a domestic scenario. Because as I said, of the limitation of getting the data, because of competition and various other factors, your efficiency and various other factors that would play quite a bit of a role in the domestic hodgepodge of our transactions. So on the bigger front, I think these are some of the areas which I thought were relevant. Nothing that else comes to my mind right now.
I think that's very useful, Mr. Thar. Thank you so much for spending your time and sharing your experiences with our readers. On behalf of Taxsutra and CK Wolters Kluwer, we once again thank you for talking to us on this domestic TPedia forum. I also thank all the viewers for watching this hangout, and do visit our Domestic TPedia website. The URL is domestictp.taxsutra.com. It's a free community-based initiative wherein you could put your comments, give your views on various issues, and collaboratively all the professionals can sort of exchange their thoughts to sort of decode this new law on domestic transpricing. Thank you so much once again for this hangout.
Thank you.